Now, Julian Zimboko is an economic analyst at StratLink Africa. He's with me in studio tonight. You guys must be pretty chuffed. You forecast a rate hike of some magnitude at the July 7 meeting in this month's note to client. Having seen the CBK's decision today, how does it compare to your expectations?
Roma, thanks for having me, first of all. I think it was really a matter that was foreseeable. We have experienced elevated monetary risks. Inflation has been edging up closer to the 7.25% upper limit target. And also the shilling has been flirting with the 100 units of exchange to the greenback mark. And I think if you look at all factors being considered, there was a highly likely factor that they would raise the benchmark rate further.
Indeed. What's the outlook, though, for inflation in the second half of the year? As you mentioned, yes, we are fairly close to 7.25%, about 20 basis points off that. But when are we likely to breach it, and what would drive it beyond that level? A recovery in oil prices, bad long rains, or just the weakening shilling?
I think what we can say with certainty, Rama, is the fact that we expect to see inflation continue to creep up through the remaining 2 quarters. But we can say with absolute certainty that this is the point at which it will cross the 7.25% mark, because a lot of factors come into consideration, and we would like to weigh the transmission effect of the hike just undertaken by the central bank, especially looking at it from a money supply perspective. We know that the levels have been high in terms of growth, but we expect to see this beginning to tone down in the coming 3 or so months.
Indeed. Speaking, though, of transmission effects, I can't remember the last time, aside from 2011, when we had a 300 basis point rate hike in a span of about 8 weeks. Is this likely to dampen, to push back government's borrowing plan for the fiscal year 2015-2016?
No, we don't anticipate that, actually, because if you look at the government domestic borrowing target is about 229 billion shillings in the financial year 2015-16. And if you consider that government consumption is actually a very key component of aggregate demand in the economy, it would be shooting itself on the foot to again tone down its domestic borrowing. And therefore, we don't expect that because it would again, the monetary tightening itself is likely to impact on growth, and therefore now we don't expect to see the government again now cutting back on its borrowing targets.
Indeed, but the flip side of the argument, Julian, would be that, I mean, would the government want to borrow at just about any price?
The question is where else would it source the revenue from? You and I know the tax net has been a challenge for the government, and therefore when it comes to options available on the table, it really doesn't have much on its options. So I think either way they would be compelled to play by the rules of the game.
Indeed, damned if they do, damned if they don't. Let's look at the correlation between CBR and GDP growth rates. How big a hit should you expect to growth in the second half of the year, given this 11% level of CBR? I think it's important to begin by highlighting that a number of factors affect growth over and above monetary policy. But looking at it historically, if you look at between Q4 2011 and Q2 2012, we had a similar hike of about 200 basis points, and then we saw now growth decelerate from 5.4 to 3.3. But our expectation that we will see, if we are to see deceleration in growth, we'll see anything ranging between 4 and 4.5% in the next quarter. Indeed, we'll leave it there for the time being. As always, thank you for your input, Julian. Julian Zimboko there with StratLink Africa, talking us through, of course, the latest rate decision by Kenya's central bank.